We all tend to think that building wealth is the really hard part. But what if I told you that keeping it, well, that's a completely different science. And honestly, it might be even harder. So let's dive into this, because getting your head around the difference, that's the whole game. Okay, take a look at this number, 8.48%. Let that sink in for a second. What do you think that is? It's not a gain, it's a penalty. It is the price that millions of investors paid last year for being human. And this slide right here explains everything. It's called the behavioral gap. So in 2024, the S&P 500 index cranked out this amazing 25% return. Incredible, right? But the average person invested in that exact same index, they only got 16.5%. That 8.48% gap is the cost of trying to time the market. It's what happens when we make emotional decisions, letting fear and greed drive the bus right off a cliff. So the big questions are, why does this keep happening year after year? And more importantly, how can you build a financial plan that's designed not just to grow your wealth, but to actually protect it and make it last? That's what we're going to break down pillar by pillar. Okay, first things first, we have to understand where real long-term wealth has actually come from throughout history. We've got to identify the most powerful engine for growth we have. Let's start with this absolutely mind-boggling figure, $107,409. Think about this. That is what one single dollar invested in the broad U.S. stock market back in the year 1900 would have grown into by the end of 2024. That's the raw power of compounding in the world's most productive companies. And this chart just puts it in stark relief, doesn't it? That same dollar, if you put it into safe government bonds, grew to just $268. And inflation, it chewed up that dollar's buying power until it was worth just $37. So the key takeaway here is just undeniable. Over the long run, owning a piece of productive businesses through stocks has been the absolute hands-down champion of creating wealth. It's not even close. But hold on. I know what so many of you are thinking right now. What about real estate? Isn't that the tried and true, safer way to build a fortune? It's a great question. Let's look at the data. Now, if you just look at the surface, stocks seem to win, no problem. From 1992 to 2024, the S&P 500 returned over 10% a year, while housing prices went up about 5.5%. But here's the thing, that comparison is totally misleading. It misses two gigantic factors for real estate, rental income and the absolute magic of leverage. Using the bank's money. But that leverage, it comes with a price tag. This is what we call the operational friction of owning real estate directly. You've got property taxes, constant maintenance, management fees if you don't do it yourself, and it's incredibly illiquid. Now compare that to an S&P 500 ETF. You can buy or sell that thing in seconds, and the annual fee is, maybe 0.03%? So yeah, real estate can be powerful, but it's a high-friction, hands-on business. It's not a passive investment. Okay, so let's shift gears and move on to our second pillar, understanding the hidden threats. These are the invisible forces that are constantly working to separate you from your wealth. And the single biggest threat is the one we started this whole conversation with, that behavioral gap. It's not just a number on a page. It's the direct result of our own psychological wiring fighting against our best long-term interests. I mean, really think about this. When the markets get volatile and start dropping, your brain's amygdala, that's the ancient primal part that handles fear, it just lights up. It triggers a literal fight or flight response, the same one you'd get if you saw a tiger in the jungle. Your brain screams at you to sell everything, to stop the pain, even when that's the absolute worst thing you could possibly do. Your own biology is your portfolio's greatest enemy. And this biology leads us right into these classic traps. First, loss aversion. We feel the pain of a loss about twice as much as the pleasure from a gain. That's why we sell at the bottom. Then there's herding. We followed the crowd, piling into bubbles at the top and panic selling with everyone else at the bottom. And finally, we have crippling short-termism. The average holding period for a stock fund today is less than 5 years. That's not even one full market cycle. Another huge threat is just believing in myths. Like the idea that a strong economy means the stock market is going to do great. The data shows this is just not true. There is basically zero correlation between a country's annual GDP growth and its stock market returns. Why? Well, because today's biggest companies are global, and market returns are driven way more by investor feelings and what people are willing to pay for stocks than by what the local economy is doing. And that brings us to a hidden risk that's kind of crept up on everyone right now: concentration. The US stock market has done so well for so long that it now makes up over 60% of the entire global stock market. That is a massive, massive bet on one single country to just keep winning forever. And investors are paying a huge premium for that bet. Right now, US stocks are trading at 22 times their expected future earnings, while stocks in the rest of the world are trading at a much more reasonable 13 times. And this is the part that should make you pause. This situation looks eerily similar to Japan's market back in the late 1980s, right before it went basically nowhere for 35 years. Okay, so we've identified the engine of growth, and we've pointed out the major threats. Now for the most important part, the defensive playbook. These are the tools and strategies you absolutely need to preserve your wealth for the long haul. One of the few things you can actually control is taxes. Sophisticated investors don't just invest, they manage their taxes relentlessly. For real estate, that means using tools like a 1031 exchange, which lets you defer capital gains tax when you sell a property by rolling the money into a new one. For stocks, it means using advanced strategies like tax loss harvesting and direct indexing to minimize that tax drag every single year. All right, now let's talk about actually spending your wealth. You've probably heard of the famous 4% rule. It's a pretty solid rule of thumb that says you can pull out 4% of your portfolio in your first year of retirement, adjust that for inflation each year, and you'll have a very high chance of your money lasting for at least 30 years. But, and this is a huge but, if your goal isn't just to make the money last for your lifetime, but to maintain that wealth for generations, well, the 4% rule is just too aggressive. The research is clear. For true generational maintenance, the truly safe withdrawal rate is much closer to 3.3%. It's a way more conservative number for sure, but it's built to last forever. So let's pull all these pieces together into a final blueprint. This is the synthesis of everything we've talked about, the core philosophy for not just building wealth, but for keeping it. When you boil it all down, it really comes down to these 4 things. 1, have a long-term mindset. I'm talking 20-year horizons. Over basically any 20-year period in history, the stock market has almost never lost money. 2, manage your taxes structurally, not as some afterthought. 3, develop behavioral discipline. The best way? Automate your investments and just learn to ignore the daily noise. That's how you close that behavioral gap. And 4, if you want the wealth to last for generations, be strategic about how you spend it. Adopt that conservative 3.3% withdrawal rate. And that really leaves us with one last question you have to ask yourself. Is your financial strategy built like a bet at a casino, just hoping you get on a lucky streak? Or is it the patient, deliberate work of an architect, building a solid foundation with the right materials, a structure that's actually designed to stand for generations? The choice, and ultimately the outcome, is entirely yours.